School of Management Studies IGNOU presents an audiobook on the course MMPC 010 titled Managerial Economics for MBA Program. Presenting Block 3 titled Production and Cost Analysis. Unit 8 Short Run Cost Analysis Part 1.
Objectives. After going through this unit, you should be able to understand some of the cost concepts that are frequently used in the managerial decision-making process, understand short-run cost function, understand applications of short-run cost function in managerial decisions making. Introduction. The analysis of cost is important in the study of managerial economics because it provides the basis for two important decisions made by managers: A. Whether to produce or not, and B. How much to produce when a decision is taken to produce. There are two types of cost analysis: short-run cost analysis and long-run cost analysis. In this unit, we shall discuss some important cost concepts that are relevant for managerial decisions. We analyze the basic differences between these cost concepts and also examine how accountants and economists differ on treating different cost concepts. We shall discuss short-run cost function and its applications in managerial decision-making. The short-run cost estimates are helpful to managers in arriving at the optimal mix of inputs to achieve a particular output target of a firm. Actual costs and opportunity costs. Actual costs are those costs which a firm incurs while producing or acquiring a good or service like raw materials, labor, rent, etc. Suppose we pay 150 rupees per day to a worker whom we employ for 10 days. Then the cost of labor is 1500 rupees. The economists call this cost as accounting costs because traditionally accountants have been primarily connected with collection of historical data in reporting a firm's financial position and in calculating its taxes. Sometimes the actual costs are also called acquisition costs or outlay costs. On the other hand, opportunity cost is defined as the value of a resource in its next best use. For example, Mr. Ram is currently working with the firm and earning 5 lakh rupees per year. He decides to quit his job and start his own small business. Although the accounting cost of Mr. Ram's labor to his own business is zero, the opportunity cost is 5 lakh rupees per year. Therefore, the opportunity cost is the earnings he forgoes by working for his own firm. One may ask you that whether this opportunity cost is really meaningful in the decision-making process. Opportunity cost can be similarly defined for other factors of production. For example, consider a firm that owns a building and therefore do not pay rent for office space. If the building was rented to others, the firm could have earned rent. The foregone rent is an opportunity cost of utilizing the office space and should be included as part of the cost of doing business. Sometimes these opportunity costs are called as alternative costs. Explicit and implicit costs. Explicit costs are those costs that involve an actual payment to other parties. Therefore, an explicit cost is the monetary payment made by a firm for use of an input owned or controlled by others. Explicit costs are also referred to as accounting costs. For example, a firm pays 100 rupees per day to a worker and engages 15 workers for 10 days. The explicit cost will be 15,000 rupees incurred by the firm. Other types of explicit costs include purchase of raw materials, renting a building, amount spent on advertising, etc. On the other hand, implicit costs represent the value of foregone opportunities but do not involve an actual cash payment. Therefore, an implicit cost is the opportunity cost of using resources that are owned or controlled by the owners of the firm. Implicit costs are just as important as explicit costs, but are sometimes neglected because they are not as obvious. The implicit cost is the foregone return the owner of the firm could have received had they used their own resources in their best alternative use rather than using the resources for their own firm's production. For example, a manager who runs his own business forgoes the salary that could have been earned working for someone else, as we have seen in our earlier example. This implicit cost generally is not reflected in accounting statements, but rational decision making requires that it be considered. Accounting costs and economic costs. For a long time, there has been a considerable disagreement among economists and accountants on how costs should be treated. The reason for the difference of opinion is that the two groups want to use the cost data for dissimilar purposes. Accountants tend to take a retrospective look at firms' finances because they keep trace of assets and liabilities and evaluate past performance. The accounting costs are useful for managing taxation needs as well as to calculate profit or loss of the firm. On the other hand, economists take forward-looking view of the firm. They are concerned with what cost is expected to be in the future and how the firm might be able to rearrange its resources to lower its costs and improve its profitability. They must therefore be concerned with opportunity cost, since the only cost that matters for business decisions are the future costs. It is the economic costs that are used for decision making. Accountants and economists both include explicit costs in their calculations. For accountants, explicit costs are important because they involve direct payments made by a firm. These explicit costs are also important for economists as well because the cost of wages and materials represent money that could be useful elsewhere. Accountants and economists use the term profits differently. Accounting profits are the firm's total revenue less its explicit costs. But economists define profits differently. Economic profits are total revenue less all costs, explicit and implicit costs. The economist takes into account the implicit costs in addition to explicit costs in order to retain resources in a given line of production. Therefore, when an economist says that a firm is just covering its costs, it is meant that all explicit and implicit costs are being met, and that the entrepreneur is receiving a return just large enough to retain his or her talents in the present line of production. If a firm's total receipts exceed all its economic costs, the residual accruing to the entrepreneur is called an economic profit or pure profit. Controllable and non-controllable costs. Controllable costs are those which are capable of being controlled or regulated by executive vigilance and therefore can be used for assessing executive efficiency. Non-controllable costs are those which cannot be subjected to administrative control and supervision. Most of the costs are controllable, except, of course, those due to obsolescence and depreciation. The level at which such control can be exercised, however, differs. Some costs, like capital costs, are not controllable at factory's shop level, but inventory costs can be controlled at the shop level. Out-of-pocket costs and book costs. Out-of-pocket costs are those costs that improve current cash payments to outsiders. For example, wages and salaries paid to the employees are out-of-pocket costs. Other examples of out-of-pocket costs are payment of rent, interest, transport charges, etc. On the other hand, book costs are those business costs which do not involve any cash payment, but for them a provision is made in the books of account to include them in profit and loss accounts and take tax advantages. For example, salary of owner-manager, if not paid, is a book cost. The interest cost of owner's own fund and depreciation cost are other examples of book cost. The out-of-pocket costs are also called explicit costs and correspondingly book costs are called implicit or imputed costs. Past and future costs. Past costs are actual costs incurred in the past and they are always contained in the income statements. Their measurement is essentially a record-keeping activity. These costs can only be observed and evaluated in retrospect. If they are regarded as excessive, management can indulge in post-mortem checks to find out the factors responsible for the excessive costs, if any, and take corrective actions for future. Past costs serve as the basis for projecting future costs. Future costs are those costs that are likely to be incurred in future periods. Since the future is uncertain, these costs have to be estimated and cannot be expected to be absolutely correct figures. In periods of inflation and deflation, the two cost concepts differ significantly. Managerial decisions are forward-looking and therefore they require estimates of future costs. Unlike past costs, future costs are subject to management control and they can be planned or avoided. Management needs to estimate future costs for a variety of reasons such as expense control pricing, projecting future profits, and capital budgeting decisions. When historical costs are used instead of explicit projections, the assumption is made that future costs will be the same as past costs. In periods of significant price variations, such an assumption may lead to wrong managerial decisions. Historical and replacement costs. The historical cost of an asset is the actual cost incurred at the time the asset was originally acquired. In contrast to this, replacement cost is the cost which will have to be incurred if that asset is purchased now. The difference between the historical and replacement costs results from price changes over time. Suppose a machine was acquired for 50,000 rupees in the year 2015 and the same machine can be acquired for 1,20,000 rupees in the year 2021. Here, 50,000 rupees is the historical or original cost of the machine and 1,20,000 rupees is its replacement cost. The difference of 70,000 rupees between the two costs has resulted because of the price change of the machine during the period. In the conventional financial accounts, the value of assets is shown at their historical costs. But for decision making, firms should try to adjust historical costs to reflect price level changes. If the price of the asset does not change over time, the historical cost will be the same as the replacement cost. If the price raises, the replacement cost will exceed historical cost and vice versa. During periods of substantial price variations, historical costs are poor indicators of actual costs. Private costs and social costs. A further distinction that is useful to make, especially in the public sector, is between private and social costs. Private costs are those that accrue directly to the individuals or firms engaged in relevant activity. Social costs, on the other hand, are passed on to persons not involved in the activity in any direct way. That is, they are passed on to society at large. Consider the case of a manufacturer located on a bank of a river who dumps the waste into water rather than disposing it off in some other manner. While the private cost to the firm of dumping is zero, it is definitely harmful to the society. It affects adversely the people located down current and incur higher costs in terms of treating the water for their use or having to travel a great deal to fetch potable water. If these external costs were included in the production costs of a producing firm, a true picture of real or social costs of the output would be obtained. Ignoring external costs may lead to an inefficient and undesirable allocation of resources in society. Relevant costs and irrelevant costs. The relevant costs for decision-making purposes are those costs which are incurred as a result of the decision under consideration. The relevant costs are also referred to as the incremental costs. Costs that have been incurred already and costs that will be incurred in the future, regardless of the present decision, are irrelevant costs as far as the current decision problem is concerned. There are three main categories of relevant or incremental costs. These are the present period explicit costs, the opportunity costs implicitly involved in the decision, and the future cost implications that flow from the decision. For example, direct labor and material costs and changes in the variable overhead costs are the natural consequences of a decision to increase the output level. Also, If there is any expenditure on capital equipments incurred as a result of such a decision, it should be included in full, notwithstanding that the equipment may have a useful life remaining after the present decision has been carried out. Thus, the incremental costs of a decision to increase output level will include all present period explicit costs which will be incurred as a consequence of this decision. It will exclude any present period explicit cost that will be incurred regardless of the present decision. The opportunity cost of a resource under use, as discussed earlier, becomes a relevant cost while arriving at the economic profit of the firm. Many decisions will have implications for future costs, both explicit and implicit. If a firm expects to incur some costs in future as a consequence of the present analysis, such future costs should be included in the present value terms if known for certain. Sunk costs and incremental costs. Sunk costs are expenditures that have been made in the past or must be paid in the future as part of contractual agreement or previous decision. For example, the money already paid for machinery, equipment, inventory, and future rental payments on a warehouse that must be paid as a part of long-term lease agreement are sunk costs. In general, sunk costs are not relevant to economic decisions. For example, the purchase of specialized equipment designed to order for a plant, we assume that the equipment can be used to do only what it was originally designed for and cannot be converted for alternative use. The expenditure on this equipment is a sunk cost. Also, because this equipment has no alternative use, its opportunity cost is zero and hence sunk costs are not relevant to economic decisions. Sometimes the sunk costs are also called as non-avoidable or non-escapable costs. On the other hand, incremental costs refer to total additional cost of implementing a managerial decision. Change in product line, change in output level, adding or replacing a machine, changing distribution channels, etc. are examples of incremental costs. Sometimes incremental costs are also called as avoidable or escapable costs. Moreover, since incremental costs may also be regarded as the difference in total costs resulting from a contemplated change, they are also called differential costs. As stated earlier, sunk costs are irrelevant for decision making as they do not vary with changes contemplated for future by the management. It is the incremental costs which are important for decision making purpose. Direct costs and indirect costs. There are some costs which can be directly attributed to production of a given product. The use of raw material, labor input, and machine time involved in the production of each unit can usually be determined. On the other hand, there are certain costs like stationery and other office and administrative expenses, electricity charges, depreciation of plant and buildings, and other such expenses that cannot be easily and accurately separated and attributed to individual units of production, except on arbitrary basis. When referring to the separable costs of first category, accountants call them the direct or prime costs per unit. The accountants refer to the joint costs of the second category as indirect or overhead costs. Direct and indirect costs are not exactly synonyms to what economists refer to as variable costs and fixed costs. The criterion used by the economists to divide cost into either fixed or variable is whether or not the cost varies with the level of output, whereas the accountant divides the cost on the basis of whether or not the cost is separable with respect to the production of individual output units. The accounting statements often divide overhead expenses into variable overhead and fixed overhead categories. If the variable overhead expenses per unit are added to the direct cost per unit, we arrive at what economists call as average variable cost. Separable costs and common costs. Costs can also be classified on the basis of their traceability. The costs that can be easily attributed to a product, a division, or a process are called separable costs. On the other hand, common costs are those which cannot be traced to any one unit of operation. For example, in a multiple product firm, the cost of raw material may be separable product-wise, but electricity charges may not be separable product-wise. The separable and common costs are also referred to as direct and indirect costs respectively. The distinction between direct and indirect costs is of particular significance in a multi-product firm for setting up economic prices for different products. Total cost, average cost, and marginal cost. Total cost, TC, of a firm is the sum total of all the explicit and implicit expenditures incurred for producing a given level of output. It represents the money value of the total resources required for production of goods and services. For example, a shoemaker's total cost will include the amount he or she spends on leather, thread, rent for his or her workshop, interest on borrowed capital, wages and salaries of employees, etc., and the amount he or she charges for his or her services and funds invested in the business. The total concept is useful in break-even analysis and finding out whether a firm is making profit or not. Average cost, AC, is the cost per unit of output. That is, average cost equals the total cost divided by the number of units produced. Marginal cost, MC, refers to the change in total cost associated with a 1 unit change in output. Marginal cost is the extra cost of producing one additional unit. At a given level of output, one examines the additional costs being incurred in producing one extra unit, and this yields the marginal cost. This cost concept is significant to short-term decisions about profit maximizing rates of output. For example, in an automobile manufacturing plant, the marginal cost of making one additional car per production period would be the labor, material, and energy costs directly associated with that extra car. Marginal cost is that subcategory of incremental cost in the sense that incremental cost may include both fixed costs and marginal costs. The marginal and incremental cost concepts are needed in deciding whether a firm needs to expand its production or not. In fact, the relevant costs to be considered will depend upon the situation or production problem faced by the manager.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 010, titled Managerial Economics. Course coordinator Dr. Leena Singh. Voiceover by Renuka. Edited by Savita. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.